Good afternoon, everyone. It is 2 o'clock. It is time to call our Budget and Finance Committee meeting to order. The first item on the agenda is approval of minutes from the August 8th, 2019 Finance Committee meeting. Hope everyone's had a chance to look at those. Any corrections, deletions? If not, I'll entertain a motion. Proper motion and a second. All in favor indicate by saying aye. Aye. Any opposed? Item number 2, consideration of resolution number 2019-80, a resolution adopting a revised vendor protest procedure for City of Franklin procurements not pertaining to new construction. Brian, your name is on there.
Good afternoon. My name is Brian Wilcox. I'm the purchasing manager for the City of Franklin. We are bringing to you a draft proposed revision to the vendor protest procedure, which was last updated in 2017. And the purpose of this revision would be to reflect the protest provision included in Ordinance 2019-24, an ordinance that allows for the use of competitive sealed proposals as a procurement method. That ordinance was recently enacted by the Board of Mayor and Aldermen. So staff recommends the Board of Mayor and Aldermen consider approving Resolution 2019-80, a resolution adopting a revised vendor protest procedure for the City of Franklin procurements not pertaining to new construction. I'd be glad to take questions.
Any questions? Then I'll entertain a motion that we pass this along to the full board for approval. Second. All in favor indicate by saying aye. Aye. Any opposed? Item 3, consideration of resolution number 2019-82, a resolution adopting a revised purchasing policy for City of Franklin procurements not pertaining to new construction. Right, you're on there again.
Thank you. In this case, the last time this policy was updated was earlier this calendar year. Since then, we've had a few items come up that cause us to not want to wait until our usual cycle of asking you to look at this in June of each year for the following fiscal year. And so the purpose of today's recommendations are to clarify the meaning and update the use of the terms responsible respondents and responsive submittals and variations on those terms. Secondly, to expand to include interchangeability of the component parts of a manufacturer-specific system already in use. One category of sole source purchases valued at or greater than $25,000 that do not require individual authorization by the Board of Mayor and Aldermen, but which still shall be reported to the Board of Mayor and Aldermen. And then thirdly, to otherwise update the city's policy. So staff recommends the board approve Resolution 2019-82, a resolution adopting a revised purchasing policy for city procurements not pertaining to new construction. You have a red line version included with your agenda materials to show each of the changes, and I'd be glad to take any questions.
Any questions? Then I'll entertain a motion that we forward this to the full board with our recommendation. Motion to move to the full board. Second. All in favor indicate by saying aye. Aye. Any opposed?
Thank you very much.
Thank you. Item 4, consideration of the draft resolution 2019 resolution to revise the organizational chart of the police department. Chief Faulkner and Michael, you're up.
Chief is here. This is a fairly straightforward modification in terms of how we deal with some of our records positions and creating a differentiation between senior and records technicians, I believe. So, and it is a budget neutral modification to the organizational chart. Chief, did I say it okay? All right. Sorry.
All right.
It's a very minor change. We're just recognizing one of the women who is a senior records technician, does the training for other employees.
Any questions? I'll entertain a motion we forward that resolution to the full board with our recommendation.
Move the full board.
favor indicate by saying aye. Aye. Any opposed? Thank you, Chief.
Thank you very much.
Item 6, consideration of draft resolution 2019-98, a resolution to revise the organizational chart within the Building and Neighborhood Services Department. Tom, you and Mike are up again. Tom, you're up.
This is somewhat similar in terms of we're differentiating some positions. We have a building inspection supervisor position that we want to establish as opposed to the inspector 4 position, which had those same responsibilities. We're just differentiating inspectors and inspectors who supervise. Is that correct?
That's it. As you notice in the current organizational chart, we have the 2 Inspector 4 positions. And over the years, those individuals have carried supervisory responsibilities. And we wanted to clarify that role and make sure that it was accounted for in the job description and in the organization chart. And that's what we're doing with this.
This also is a budget neutral change.
Motion to move to full board.
Proper motion, second. All in favor indicate by saying aye. Aye.
Can I make an introduction while I'm here?
Let's do it, yeah.
If you haven't met this gentleman before, I'd like to introduce Mr. Patrick Burrell, right here. Raise your hand.
Stand up, yeah. Hey.
Some of you may have met Patrick before, but as you recall from earlier in the year, we created 2 assistant director positions, and they have been appointed. And Patrick is our new assistant director of Building and Neighborhood Services for Building Services. He was previously one of those gentlemen in the Inspector 4 position, and part of our reorganization and improving and clarifying leadership roles within the department. This is a continuation in specifying these supervisor roles. And you will probably be seeing more of Patrick, and we appreciate having him in that role.
Thank
And our other assistant director is Alex Brown.
Alex Brown.
Talk about Alex's position real quick.
Alex is my former position. He's the Assistant Director for Development Services, and it's more development services and information related in terms of overseeing our permitting operations and property maintenance and zoning sections, and the role that our department plays through permitting and the interactions with every department involved in the development process from beginning to end. And as you know, over the years, we've kind of had a lead role in implementing some of our technology improvements to support the development activities. And so Alex has also fleeted up from his previous position as the permitting supervisor to now the Assistant Director for Development Services. And hopefully over time, you'll be seeing both of those 2 gentlemen more and more.
Great.
Thank you for being here.
Thank you.
Let's go to item 6. Consideration of draft resolution 2019-99, a resolution to adopt a revised investment policy for non-pension related assets.
Well, this one says Mike Lowe, but this is really going to be me today, so.
All right.
Thank you, Mr. Chairman. And joining me for the remainder of the meeting, I want to first of all introduce, we have Mr. Dave Westcott, and he is here with the city's investment advisor, government portfolio advisors. And he's going to give us a presentation here in a couple of items, and I'll do a more formal introduction of Dave in just a moment. But Dave and his team at GPA has advised the city on reviewing our investment policy. This was last amended by the board back in 2017. We did look at it. We do look at it on an annual basis. We did that in 2018 and did not recommend any changes. Here in 2019, we are recommending 4 changes to this policy, primarily cleanup in nature, but there's some things that we are recommending to change at this time. We, of course, our source document is our Tennessee State Code, and there is a list of allowable investments for municipalities. Those are different than counties in Tennessee, but we have a little bit more leeway in Tennessee as a municipality, as well as a municipality of our size. And so we make sure that we are in accordance with that policy, both in language and in spirit. A little bit of what we're going to talk about here just for a moment is more of in spirit of the state code. The first proposed change we have is we want to separate CDs and other evidences of deposits to further help us monitor those for compliance purposes, because of course CDs can be 1 year or 2 years. They can be a little bit different duration depending on what you purchase, but it's not the same thing as just an overnight account, which is what an example would be the local government investment pool for the state of Tennessee. We actually, on an overnight basis, can request to pull some of our money back, and that money's available the very next day. So we recognize that a CD is for a longer period of time than some other very, very short-term investment vehicles, and so we are going to separate that out for monitoring of the investments. They're all allowable investments, but just we want to be able to monitor those separately. We also are going to are wanting to update the paragraph related to cash benchmarks. That is something that we do monitor our benchmarks regularly, and we have to monitor benchmarks as according to the investment risk as well as durations, and we do have some clarification in that section 11. We also added a clarifier to the qualifier to the use of commercial paper as an investment vehicle. That is a commercial paper, which is an investment of 270 days or shorter. It is a allowable investment in Tennessee Code for cities. We are adding a qualifier to establish the minimum rating of A1 plus or equivalent. We've spoken with GPA about this, and certainly commercial paper with an A1 plus rating is very, very highly rated commercial paper, and it's still a short-term instrument. So we currently do not have any commercial paper purchased in our portfolio. It's not something that we've at least done for some time, but while we are leaving that in the policy, we are adding just that qualifier of the strong rating for commercial paper. And then finally, we are cleaning up some language related to money market mutual fund investments. Certainly, we don't, as a city, typically, we don't invest in what you might consider mutual funds because of risks, but there is a semantics to how state law refers to mutual funds and what we as a government do. And that was something that we, for probably the last 6 months or so, have been discussing with GPA, is that we would like to clarify that language within our policy, that we certainly, we have institutional share class of money market mutual funds that are invested only in governmental obligations and very highly rated in investments. Is there any?
No, I think that's good coverage of it.
But we did want to clarify that in our policy.
Okay. Well, let me ask you this. We'll vote on this as far as the resolution is concerned. Is item 8 also related?
Item 8 is actually going to be a presentation of our overall investment
Okay.
presentation, and we typically, when we put our agendas together, put together action items together, and then Dave's presentation is going to take a little bit of time, and if you've seen the presentation, he's going to talk about the investment market that we're in right now for governmental securities, and then he's going to also talk about our own portfolio. So if you choose to go ahead and recommend this to the full board.
No, that's fine. No, just stay where you are.
Mm-hmm.
Entertain a motion on the resolution 2019-99 as presented.
Motion move to full board.
All in favor indicate by saying aye. Aye. Any opposed? All right. Let's go to item 7 then, consideration of draft ordinance 2019-36. It's a first quarter budget amendment. Christine, Michael,
I'm going to defer to
you're going to defer to Michael?
my colleague, our budget manager.
Good afternoon. My name is Michael Walters Young. I'm your Budget and Strategic Innovation Manager. In our ever zealous efforts to try to minimize the number of times in front of you for budget amendments, this is the first one of this year. Hopefully we'll have no more than 2 or 3, but it is a rather large amendment that has 4 components. I want to take a few minutes and walk you through each of them. The first is the hallmark sort of reason why we do a first quarter budget amendment, and that is to move the annual wage increases out of the general and the administrative division budgets within respective funds. So in the water management fund, it's the monies for annual wage increases are in the water and wastewater general departments respectively, and in the general fund, it is in the, well, literally general expenses department. In sanitation, it is in the administration division, and in stormwater, it's actually in the streets division, and anything that needs to be transferred over gets moved over to engineering. This is exactly what we've done for the last 3 to 5 years. All of these wages were effective July 1, and employees have been receiving that cost of living and merit adjustments since the first effective paycheck of this fiscal year. The second and largest single component of this budget amendment is actually $9.3 million from 7 different funds to fund 22 separate components of capital projects. On August 13th of this past year, you approved by majority vote Resolution 2019-69, which was 68, sorry, which was the list of 30 projects for the fiscal 2019 through 2028 capital investment plan. In order to get moving and try to get dirt turned and projects done, we wanted to make sure at the next available opportunity, which was this meeting, we would begin the process to physically move money out of the respective cash funds into our capital projects fund. The list on page 2 of your memo and on Granicus itemizes not only what those projects are in fiscal 2020, but the phase with which we are intending the monies to be used for and the dollar amounts for each of those projects. This is not, as you'll see at the bottom of the list, these 22 projects are not the only capital projects that, of course, we are taking on, nor that have been budgeted. There are 9 other projects which are either in bond proceed funds, primarily things like McEwen Phase 4, McEwen Phase 5, Franklin Road, et cetera, but also things like Fire Station 7, which has been perennially budgeted within the Facilities Tax Fund. 2 items of note on this list for your future consideration. About a third of the way down, ST 16030, the Lewisburg Avenue sidewalk improvements will be coming before you, I believe, in your next work session to discuss for options. We are proposing appropriating $428,000 and change for design this year. You will be given a series of options. The CIP has approved the cheapest of the options that are put in front of you, FYI. Of which $428,000 is set aside for design, and we believe that this entire list is respective and responsible for what we can get done in the ensuing 9.5 months of this fiscal year. The second item you'll see is the only one with an asterisk, and that is SW 19003, and that's the Army Corps of Engineer home raising project. We are proposing that you transfer the full maximum match of $700,000 into the capital projects fund. We have not received any further guidance, at least that I know of in the last week, regarding the Corps in terms of the timing of when those monies, the quote-unquote city match, the 50% of the 35% that you approved to subsidize homeowners for in getting the home raising done. By doing this, however, you've got the full allocation, your quote-unquote liability is covered, and whenever that amount comes to us, you'll be prepared and we'll be prepared to be able to expedite the processing of those funds. All totaled, we're looking at 31 projects to the tune of $41 million worth of capital investment planned in fiscal 2020. Now, whether or not we actually get all that done by June 30th, who knows? The other reason that this is different and significant is that it meets our commitment to all of you and to the taxpayers of this community to ensure that we are appropriating funds annually for components of capital projects. So it sort of closes that loop with all of the capital meetings that we had last summer and fall, so that you can see where the money's actually coming from, and you'll get the opportunity to appropriate those funds in 2021, in 2022, to ensure that we can have the money available to get projects done timely. The third amendment is for actually an existing capital project, and that is for the Jim Warren Tennis Courts project. This was originally appropriated in fiscal some $608 necessary to complete the project. It has been appropriated in the Parks Department, 75% and 25% out of the Hotel Motel Tax Fund. And finally is a $2.5 million transfer or amendment in the ability to take care of a contribution for the debt swap, which was discussed in the last meeting. And I'm going to turn this back over to our finance director to explain exactly what that $2.5 million is going to be used for.
Thank you, Michael. I want to just give a little bit of the thought process beyond the recommendation for the $2.5 million contribution from the general fund balance towards payment of the swap termination on the 2007 Public Building Authority bonds. We did talk about this, of course, Tuesday night in work session with the full board, and I'm going to steal a bit of thunder from my colleague, Mike Lowe, our comptroller, who's going to talk about fiscal 2019 unaudited results here at the end of our meeting. But we certainly, when we first came to the Budget and Finance Committee in August, we had not closed our books yet for fiscal 19. We still needed to learn the last sales tax month number. We had to receive our hall tax, our income tax number late in August, and we didn't have that information yet for you when we talked about contributing some cash toward that swap termination payment. With closing out the books and all the entries that go into year-end close, Mike's going to report here in a little bit that we are projecting an increase in fund balance for June 30 of 2019 of just over $3.7 million in the general fund. We closed the year before at just under $49.5 million, and for a projected 6/30/2019 fund balance of $53.2 million. We certainly do have reserves, and we allocate that fund balance to different types of important reserves, but we do have an increase to that balance. And Mike's going to talk about why he's reporting that type of an increase, that amount of an increase. But we certainly did have a strong end to sales tax for fiscal year 19. We did have a strong hall tax report that we received there in August. So his report has more details on that. But we certainly wanted to close out the books before we made a funding recommendation to you on paying down a portion of the swap termination with cash. We do recommend $2.5 million, which will go toward that paying the swap termination and not having to finance as much of that termination payment, which will allow the board the freedom to be able to restructure the principal payments as well as refinance that underlying debt as traditional fixed rate debt of the city. And we'll be receiving we project significantly lower interest rates, of course, by doing this transaction, but we do recommend paying a portion of these costs in cash and amortizing, even though it's a very short-term borrowing for what's remaining on the swap termination. We don't believe that funding $2.5 million from cash reserves will cause any liquidity issues going forward as a recommendation to the committee. So that's what's included in the budget amendment for this line item.
And when will we know kind of that final amount that we're going to have to pay to get out of the swap? Is that coming?
That's a good question. We certainly have two more public meetings. With both meetings have votes required to get to that point where we actually would price the termination. We have September 24th when the full board considers the bond resolution itself. We'll go October 8th, I'm assuming that the full board approves moving forward. We go October 8th to the Public Building Authority, ask them to approve a resolution that just acknowledges the termination of the swap. And once we get through October the 8th, we'll finish getting our bond ratings moving forward. The mechanics of actually terminating the swap, we almost do it simultaneously with taking bids on the new bonds, because we don't want to have a disparity between the market in which we price the termination as well as price the new bonds. So that typically occurs within about 24 hours of each other, if not closer. That will most likely be the first part of November, and we'll be we are already working on terms of that termination calculation, but until we get closer to the 1st of November, we'll come back, and I expect when we come back together for your final meeting of the year, which is closer to Thanksgiving, we'll be able to report on the final termination value as well as the outcome of the pricing of the new bonds.
So we're hoping to close everything by end of November, 1st to December in terms of completing the transaction. So, and
But the lock-in would be the early part of November when we actually went to take bids on the new public offering.
To close this amendment, there's a lot of money moving from a lot of different funds. And the primary reason for that, as I mentioned, is to fund capital projects. If you remember the financing discussions we had, we wanted to fund where we could and where appropriate, cash first, debt second. And so this is $9.3 million in cash that's been accumulated in our various development funds and notably, though, in the general fund. So that $4.9 million in additional fund balance, $2.5 million is going, as Christine mentioned, to the debt swap, and then $2.4 million is going to fund capital projects. But as you also just heard, of that $4.9 million appropriation, we've just added 3.7. So the net draw, if you will, from our existing capital funding account, that over 45%, is only about $1.2 million, which leaves you well beyond between $13 and $15 million of that over 45% cash funding to be considered for use in future fiscal years as we continue to implement the 10-year CIP.
So my one question, I guess now with these 22 and the other 9, have we essentially hit all of our top 10 projects and then we're moving down towards kind of the opportunity tier we talked about?
well, yeah, we're moving all of anything in the 30 projects that were listed, we're starting to advance those based on the timing of those projects. So some of it's driven by priority, some of it's just driven by the timing of certain elements. So it's really a blend of both your top priorities, but also there are things in that opportunity tier that just from a timing standpoint, it makes sense to start moving forward on. So it's everything that had some expenditure and the fiscal year 2020 that we've now are shifting into to specifically budget for. So.
Yeah, yes is the answer to your question. We expect in fiscal 2020 to spend money on the 2017 tier projects. Again, QN4, Franklin Road, Fire Station 7, Century Court improvements, et cetera. All of your top 10 projects, and then 11 of the 17 on the bottom of the list. There are certain projects, though, that simply are so far out on that but were approved for the 10-year window that we're not even at a stage. And again, we're trying to take on funding pieces of 31 projects this year that not even those are warrant any expenditure of design monies at this point.
Okay, question. So whenever we pass this in August, then again, it does mean that every one of those on that list is moving forward, period. And, you know, we've talked about the fact that I thought I remember a comment at that meeting that everything would be things would be revisited or maybe tweaked, maybe is a better word to say it, every 2 years. But really, it sounds like we've committed to every one of those.
Well, you've authorized, you've funded those projects and you've authorized us to move forward. Now, you will still make decisions along the way, along the lines of some design components. For example, we're bringing the sidewalk project to you to look at what approaches you want to take there. And so you're going to have opportunity to weigh in on every step along the way in implementing the project. So, the board changes their mind on the project, you're going to have the opportunity to weigh in on that too. But when you told us when you approved that, you told us to go ahead and move forward with advancing those projects. So you're going to start seeing them come through their different schedules at the appropriate times for those projects and get your authority to do whatever's next, whether it's design or right-of-way acquisition or, ultimately construction bid award. So you'll keep seeing lots of different steps along the way on each project.
Well, again, though, it sounds like a done deal on all of them. If that's the thing I was concerned about that day, and then I thought I got the response that we would be reassessing as we went along, and that there is some part to that that is the case. But basically, it's really a done deal on all those that was on that huge list.
Well, you've committed funding capacity to those projects. You will still make individual decisions on each project as they reach their different stages.
But there were some others that were higher on our list that did not get included on the, wait, I should say, on the alderman's list that did not get included. And then that were higher.
It was not a straight priority
Exactly.
listing.
Thank you.
It took your top tens in, and then it took a blend of other projects that reflected higher priorities from the board, but also opportunity to leverage the other grant, other outside funding, other just need that we identified, and so it's a combination.
So as an example, we approved the funding for the Liberty North Royal Oaks upgrade. Last meeting, we had another vote. I guess
Right.
that could have gotten voted down, and that would have
Right.
halted that project. So is that kind of what you're saying along the way?
Every step
there are-
along the way. When
Yeah.
you bid, when we go out to bid for construction, you'll have a decision to make. Those are all aspects. Now, what we gave you was a funding plan that takes care of all those steps to deliver a project. But each step along the way, you're gonna make a decision about what direction we're going on those and if you wanna continue. But we have basically earmarked capacity in our capital funding model to cover that group of projects, both the 2017 tier, the 2019 tier, and then what we called the opportunity tier, which is largely smaller projects that had some blend of what I described before, priority and opportunity and just need.
So this 30 projects that's here, minus the 10 that's top priority. That's the $270 million of capacity, is that, or whatever?
Yeah,
It was 293, whatever?
Yeah, so all totaled, the current iteration of the 10-year plan, we identified just north of $300 million worth
Okay.
of potential revenues for. We have committed via the resolution, as Eric indicated, to do 37 projects totaling about $281 million. So there's a little, but again, because we tried to be as aggressive as we could using prioritizing cash over debt, we've done an analysis for annual capital budgets. So to your point, Alderman Peterson, our plan is to do this list in the annual operating budget every year. So not only will it be at the contract awarding standpoint, but within the budget review, you'll be able to see what the request is for that next year's worth of money on the projects as they move forward, which ensures that we have proper funding in sequence in order to deliver projects timely moving forward.
And Michael, correct me if I'm wrong, within that group, about 46% of all those projects is funded by debt. Their balance is by some cash source
Yeah.
in that ballpark.
Yeah.
So grants or,
Right.
some other form of cash on hand from the general fund, various development funds like road impact or parkland, hotel motel, all of those elements. So if you remember when we did it previously, we were, what were we in when we originally did 2017, we were like 60-40,
Yeah.
something like that. And so we've shifted.
Inverse,
Yeah,
if
so
you
we've
will.
shifted more to a 45% debt, 55% cash sourcing for those projects. So, and when Michael gave you that number, it does include the previously approved 2017 projects that are still in the pipeline, and then the remaining projects that you added in this last group that you voted on.
And it accounts for the projects, that you are obliged to do whenever that trigger happens, such as McEwen Phase 5, partnership with Brentwood.
That's in here?
That is in there.
Yeah.
Is that the million?
Uh,
McEwen Drive interchange
No,
modifications?
that is for that's for
That's the-
interchange, that's for the I-65 interchange.
Okay.
Yeah,
That's that turn lane, that additional left
Yep.
turn lane onto the,
that's capacity just
Yeah.
at the interchange.
And so because we've only taken on 45% debt, we've also been very conservative, right? So if we have better than expected sales tax increases throughout the years, we pay down debt, we basically have more capacity to take on more projects?
We think we used a pretty conservative approach across the board on all those funds, so we keep looking at that.
This meeting is a perfect example of that. We were not counting on, when building that model, that we would be turning back $3.7 million this year. So if, to fund the original $2.4 million of capital commitment, the plan would have been that we would have drawn down from our previous accumulated cash. Turns out, we only have to take $1.2 million of that because we generated $1.2 million this year after the swap amount.
So the
So
fund,
we'll constantly be looking and seeing, once and if Mike can get to his fourth quarter report, what those new balance numbers are, and then revising and seeing, you know, if we have more cash than we anticipated. In
Right,
most funds
yeah.
this year, the answer is a positive yes.
so we have a,
Could I ask
Go
one
ahead.
more question? Did I misunderstand? I thought it was said that the Brentwood thing was in here, but I don't
It
see
is
it
in
in
there.
here.
Well,
Where is it?
not,
It's not listed
it's not in
here.
this
It's in
list
the
of
project. It is
22.
in there.
It is in the overall funding
It is
stream.
in your
Oh,
CIP.
right.
Yeah.
Oh, okay.
And thus, when we
We're
say
not
it's.
spending
But
money
it's not
this year.
listed, it's
in it.
not listed
Yeah.
here.
Right.
Yeah. We did put something in the bond sale
Mm-hmm.
for
We did include
some.
that
we have
joint
to
project?
do. Yeah, we have to do some work on the gas line. There's a
Mm-hmm.
large gas transmission line. So we're doing some early work on that, shared with Brentwood, so that is addressed before we go to
Before we
bidding
need
for
to.
construction. Yeah. So we don't want that to hold us up because we committed to delivering that project.
And we did include that piece of the project with, our piece of the project with Brentwood in the 19 bond issue, which means it will be done by the spring of '22.
Right.
and that's the gas line
Yes, the utility,
That's the
gas line
preliminary work.
preliminary
That-
thing with Brentwood.
that we needed to, within those 3 years, be working on.
So it's not in this because you don't need to budget transfer for it because you've already funded it in your capital projects fund.
Yes, that's in our bond fund
Yes.
for 2019.
Mm-hmm.
If I could say something, Mr.
Yes,
My recollection was there are a number of projects you accounted for, such as the Phase 5 of McEwen, and the gas line relocation. Several things that whenever we were instructed to rank our projects, we already knew that those had been accounted for as far as future projects that we were gonna do and we were obligated to. You know, I think this is really exciting to me. I mean, what's the number one complaint that we're getting? We're not building infrastructure and keeping up with infrastructure? Well, we are. And, you know, this is a great roadmap with how we're gonna pay for it. You know, every project that I like is not on here, but that's okay. I mean, I think we have a good consensus to move forward. I had a lot of concern the other night whenever we were talking about not doing the project there at Liberty and Mallory. And we were there considering approving a contract. It wasn't whether we were gonna vote to approve that particular plan. And I just think that sets a bad precedent. I think that whenever we've passed something, such as doing the roundabouts at Liberty and Mallory and Royal Oaks, if somebody says, I don't like that, maybe you have 100 people that come up to you that don't like that. You know, there is a response that you can give, that the entire board has already voted on the issue, and that's the direction we're going. Rather than looking backwards, it just sends a bad signal, I think. So I'm really excited about every one of these projects. Some are more favorite than the other ones. But we've got a great roadmap and we've created such a great financial plan. Let's move forward and celebrate that.
well, I guess I'm the chair, so I don't have
You're the man.
Whenever we did the McEwen, though, Phase 5, and I thought you and I may have
Yeah.
had some discussion, I didn't think the funding for Phase 5 was in the 150 million. We, you know, we were told to do 150 million. That was not in there.
Correct.
If we did not include that in there, then we were, anybody that included it was $9 million short on whatever, no, they were even, but anybody that did not include it was over the 150 million by 9, because the 9 million had to be in there.
We had already built that into our capacity model.
Okay.
The capacity we had available, because we know that is a project whose timing we don't exactly
Right.
control. It's gonna be triggered by Brentwood saying, we've got our half, then we gotta go move forward. And so that's what we're gearing up for. And so we sort of took that capacity off the table when we did the 10-year outlook, because we needed to have it available. And we're relatively certain it will need to be available in that 10-year window. So we didn't even leave that to chance in the priority process. So it's kind of off to the side, but it is incorporated in your CIP.
And again, the list that's been approved is $281 million total. But we only asked you back last fall to prioritize $150
Right.
million. Exactly because we had to reserve that capacity for existing commitments, as well as that we're currently building, AKA Fire Station 7, as well as commitments like McEwen Phase 5.
Any other questions or comments? So we're ready for the update on the non-pension related investments.
Would you be willing to make a affirmative or denial vote of ordinance 2019-36
Oh, yeah.
to the board?
I'd be willing to do that.
If that's,
Second, all in favor indicate by saying aye. Aye.
thank you, sir.
Update on the city's non-pension related investments.
Well, Mr. Chairman, I would like to give just a comment and a brief introduction for this presentation. And this is something that we do an investment update every fall, and we always look forward to doing that. And we have, at the end of June, the city's investment portfolio was around $169 million. That includes funds that are restricted toward specific capital uses. That includes bond proceeds, monies that are remaining to spend from the 2017 and 2019 bond issues. That also includes the monies that we have restricted for our utility funds, as well as our reserves of the general fund. So our investment portfolio is significant. It has risen over the last several years, and we do have a team approach to managing investments here at the city. I'm very honored to have a team that includes, and I'm going to recognize all three of these folks who I enjoy the company of working with on investments. Michael O., our comptroller, Lori Pope, our financial analyst, who does a lot of work on this effort, and Russ Truell, my predecessor, who helps provides. And he's newly back from his summer vacation to be with us. So this is your staff team that manages the investment portfolio. We are joined by government portfolio advisors to assist us in this effort. And the story, from my perspective, as someone who has been doing this now about 20 years, is we had around 10 years that we really didn't earn anything on our investments, very little. We are very restricted in the instruments that we can use to invest public funds. We are restricted in how many years we can go out. We also, we have some basic best practices that we follow, in which liquidity and safety are our top two priorities of public funds, and then maximizing our earnings is really a third qualification. We want to make sure that we have enough money to pay bills, and we want to make sure that everything that we invest in is safe and that we do not lose taxpayer money. So certainly we want to earn as much investment income as we can, but we do it within a lot of very strict parameters. And so for about a 10-year period, we earned very little. And we have been able to position ourselves in the last couple of years, and what Dave's going to speak to is where we are at currently with our investment portfolio and our earnings. The percentages they're not high, but I'll tell you they are much higher, and the dollar amounts that we're earning is much higher than we had 4 or 5 years ago, even 3 years ago. So we keep it in the perspective of we are investing public funds, and it's not necessarily perhaps what you've made in your own personal accounts, but when we compare this to where public funds were earning not too long ago, we're glad to be at this point. And Dave's going to talk about the investment environment that we're in for public funds. It's we've had a couple of years to be able to lock in some higher rates, and that's changing somewhat. And he's going to give us that observation from someone as he is, who's in this market every single day. I'd like to introduce to you Dave Westcott. He is the Chief Compliance Officer, Chief Investment Officer, as well as a Senior Portfolio Advisor with Government Portfolio Advisors. He has not appeared before your committee before, but he's been on the team that assists the city of Franklin for several years, in fact, since 2014. And he and his business partner, Deanne Woodring, has been here the last 2 years. They both provide service to our account and to staff. Dave has more than 40 years of fixed income investment management experience with a focus on the management of the operating funds of public entities. And with that introduction, I want to bring Dave Westcott for an investment report.
Thank you, Christine. It's a pleasure to be here. And I specifically want to thank you and your team for inviting me back here to have the opportunity to discuss your investments and your investment management process, and hopefully educate you on what we do and how we do it. As Christine mentioned, we are an investment advisory firm. I would characterize us as being a boutique, highly specialized investment advisory firm that specializes in investing only with public entities. So we don't work on the pension side at all. We only work on the operating side. So we're more positioned as a consultant, where we need to join your team and understand all aspects of your finances in terms of your liquidity requirements, the cash flows that you experience when you may need the liquidity, the contingent liquidity that needs to be positioned in the future for various projects that you've been discussing, the investments of the flows of those projects, and how we can maximize the earnings on those projects as the funds become available. So highly specialized, highly focused. We are definitely not the largest in the country in terms of the number of individuals in our firm. There's only 8 of us right now, soon to be 9. We only deal with 55 different accounts, but in terms of size, we're the largest in the country at $12 billion under management that manage funds in a non-discretionary manner with public entities. And the difference between non-discretionary and discretionary management, and you may have heard this in the past, is that with discretionary management, I basically just take your money and I try to create the best returns possible and give you a report at the end of the quarter and say, here's what's happened, here's what's done. Non-discretionary is completely different. Non-discretionary brings value over and above just the returns of the funds, returns on the funds. And that is that we work together as a team with your investment team to try to maximize and understand the cash flows of the entity that we're working with, and use that to maximize the earnings of those cash flows as they come in. So it's very consultative. Every transaction is presented to Christine and her team for review. It's justified, it's documented. They make the approval, and then we go out and execute the transaction in a competitive way over an electronic platform, accessing as many as 10 to 15 different market makers on every transaction, and then documenting those transactions so you have a record of who we used, how we were using it, why we were using it, and it's a complete trail of every transaction and documentation for your historical files. I just want to start off and just take a few minutes and talk about the investment environment, because it's extremely important in terms of how it's impacted the city's earnings potential. I don't know which is the best way here. We've got screens up in here. I don't, do you guys have access on your screens?
Yes.
In the back. Okay, so we're surrounded. We're good.
Screens everywhere.
But I want to talk a little bit about the investment environment and the importance to the returns of the cash flow. And we can see that the investment environment has been very favorable in the last several years because it's substantially increased your interest earnings. But on page 5, if you could, this is a review of what's happened in the second quarter. And that is a continuation of really what happened in the late fourth quarter of 18 and the first quarter of 2019. And that is interest rates went through a transition that only occur about once every 10 years. And we went from a Federal Reserve raising interest rates in an environment where almost every time they met, they raised interest rates about 25 basis points because the economy was expanding, inflation was starting to pick up, and the normal course of action there is to try to raise interest rates to calm the economy down and prevent future inflation. And then in December of last year, they raised interest rates 25 basis points up to 2.5%, which the market deemed as too far, too fast, and too much. And they reacted with a substantial sell-off in the stock market in the latter part of December of last year. I'm sure all of you remembered if you went home and opened up your IRA statements or your retirement statements on December 31, quite shocked to see what happened from December 1 to December 31. And this was the market telling the Fed that they had raised rates too much and that they needed to lower rates. The Federal Reserve acknowledged that in the first quarter. They didn't lower rates until July 31 of this year, but the market started to anticipate that the Fed had made a change, a transitional change from raising interest rates to now starting to lower interest rates. We got the decrease in July 31. And we're expecting another decrease next week when the Fed meets again of 25 basis points. The market is now discounting a substantial drop in interest rates, and I'll show you some charts that'll verify that over the next year. On page 6, this is kind of a big picture of where interest rates have been over the last 10 years. The green line is the yield on the 2-year Treasury note, and the blue line is the yield on 3-month Treasury bills. So you can see we went through a long period following the recession of 08-09 where interest rates were just above zero. You can see the 3-month bill hovering close to that zero line all the way until November of 2015, which is the first time period in which the Fed raised rates by 25 basis points. And then we started this long progression to higher interest rates until the latter part of 18, and then something very interesting happened in the fixed income markets, and that is the 2-year Treasury note started yielding less than the 3-month Treasury bill, which is, as you can see from this relationship over the last 10 years, that's highly unusual, but it's very predictive that the market has changed and we're now anticipating substantially lower rates because investors were willing to buy a 2-year Treasury note at a yield that was lower than just buying a 3-month Treasury bill. They were trying to lock into these yields before we had additional declines in interest rates by the Federal Reserve. So on page 7, what happens after that first Fed rate cut historically? And we can see historically it's never one and done. It's always followed by additional cuts. The fewest cuts in the last 50 years has been 75 basis points, and the most cuts has been 650 basis points after that first cut. Well, we're only at 2.25%, so we probably don't have another 625 basis points to go. But the message is that we probably could easily go back to where we were at 25 basis points. And then I'm going to talk a little bit later on here too about the possibility of joining the rest of the world and going negative, which in my 4 decades of being in this business is still a term I just can't get my head around of paying somebody to hold my money. The Fed needs to do a couple things here in their process of lowering rates. First of all, they need to steepen the curve back out. The curve is inverted now. An inverted curve is when shorter securities yield more than longer securities. That's not normal. That only happens about once every decade. They need to get the curve back to a more normal position to where longer maturities are yielding more than shorter maturities. They're probably at least 75 basis points, if not 100 basis points away from doing that. So we know that historically we probably have at least another 3 or 4 eases in the cards before that curve can get it steepened back out. The second objective is that they need to narrow up the interest rate differential between the yields in other developed countries and the yields here in the United States. We are now the highest yielding developed country in the world, which seems a little strange because we have the highest rated credit market. We have the most liquid market in the world, and we're also the world's reserves currency. So we shouldn't be the high yielder out there. That should be somebody that doesn't have the credit quality of the United States yet we are. And so that differential needs to be adjusted. This is one of the first times in the last 50 years that yields in the United States have yielded more than yields in other countries. The last time was in the late 70s when Paul Volcker came in and raised rates up to 18%, and yields in the United States were higher than those in Europe and in Japan. Very unusual situation, though. So on page 8, this is the market for Fed funds futures. It's a little detailed and intricate here, but I want to point out the far right-hand corner column, and that's the forward rate. The columns on the left are the dates of the Federal Reserve meetings, and the far right-hand corner is where the Fed is expected, the Fed funds futures are expected to be going out forward. So if you look at the bottom right column, there's the figure there is 106. That's where the market expects Fed funds to be 1 year from now, or on September 16th of 20 at that Fed meeting. The market is discounting at 1% Fed funds, which means that your short-term earnings in your portfolio will be closer to 1% as opposed to 2% today. So we're anticipating that over the next 12 months, we could see as much as a 100 basis point decline in your interest earnings. So that's how it could possibly impact the city's portfolio. On page 9, this is an indication that we may be moving into a recession, as pointed out by the inversion in the curve. And what this chart shows in the line here is the yield relationship of the 3-month Treasury bill to the 10-year Treasury note. When it's green up there, that means the 3-month Treasury bill is yielding less than the 10-year, and the 10-year is yielding more, which makes sense. It's longer, it's more volatile, it's more variable, so it should yield more than the 3-month Treasury bill. And as you can see, that's the normal situation in the green, where the 10-year note yields a lot more than the 3-month Treasury bill, as much as 300 or 400 basis points at the point of those curves. And the red is where that relationship gets inverted. This is the 7th time in the last 50 years where that 7th or 8th time where that relationship's gone inverted. So it's a very unusual situation, but it also is a very strong predictor that we are moving into a recession. If you see those really thin gray lines before the thicker gray lines, that's the time in which the curve went inverted, and then the gray lines are recessionary periods. And so in 1969, it went inverted on January 10th, and then we had a recession right after that. On June 14th of 73, it went inverted, and we had a severe recession in 73, 74. Same thing in 78, 80, 89, 2000, and then the most recent recession. We went inverted on August 1st of 2006, and we all know what happened in 07, 08. Market turned down severely, housing market crashed, US stock market crashed, and we went into the worst recession we've had since the Depression. So we're back in that situation again where we're in an inverted curve, which is a strong predictor that we're looking at a potential recession. So how long until that recession? On the next page here, we can see that the same data that I just went over, but it shows the date of the next recession and the calendar days from when we went inverted until we experience that next recession. Over the last, let's see, 1, 2, 3, 4, 5, 6, 7 times, that has averaged 311 days from the time in which we went inverted before the economy moved into a recession. The curve went inverted this time on June 6th. So we've had about 80-some days now of inversion between the 3-month Treasury bill and the 10-year Treasury note. Going by the average of this data, that means we could move into a recession sometime in the middle to the latter part of 2020. So this is what the yield curve is telling us. Doesn't mean it's necessarily going to happen, but every time we say it's different this time, it's not, and we can see that in the last 7 or 8, 9 times, it's been a very strong predictor.
Another joke that the economists have predicted 10 of the last 3 recessions.
Yes. Actually, there's some data that the economists have been too positive, but you're right, that's the old comment. But most economists right now are not predicting a recession. You know, they're saying it's going to be different this time. There's a lot of data out there, but I think that the bond market is telling us that we should be prepared for that potential consequence. The page 11 is an interesting chart. This is a 50-year chart of Fed funds, and the yellow lines indicate when the markets went inverted. And you can see that it's always been the peak of the Fed funds market. The Fed controls when interest rates go up, and they usually are very methodical about their increases. And you can see it's very stair-stepped, as it was in 95 and it was in 2000 and 04 to 06. And then even again, it was very methodical in November of 15 through July 31 of this year until the Fed started to lower rates. But the Fed doesn't control when interest rates go down. What happens is when the Fed gets inverted, the market is telling the Fed, you are too tight. You've raised rates too much and rates need to come down. And the market decides that by moving the curve into an inverted position, and then the Fed follows. And right now, that's what's occurring, is that the Fed is responding to the interest rate markets, and they're lowering rates because of this extreme inversion in the curve and the potential for a recession sometime over the next 12 to 18 months. And so the Fed now has reverted to an easing mode, and we're expected to see that to continue throughout the year. There's really three reasons why interest rates are coming down. One is the global macro situation, where global growth has weakened considerably along with domestic growth. We've had a decline of almost 100 basis points in GDP in Europe, Japan, China, and the United States just over the last 12 months. Here in the United States, we had a 3% plus GDP in the first quarter, 2% last quarter, and it's expected to be sub 2% in the third and fourth quarter. China's GDP, I think, is at a 20-year low in terms of their growth rate. Europe and Japan are both slowing down dramatically. That's the first reason. Second reason is the negative interest rates that exist in these other countries and the divergence of capital that's causing capital to move from those super low-yielding negative countries into the United States, which creates a problem in the United States because that money has to be converted to dollars. It increases the value of the dollar, which reduces our exports competitive position, makes our exports more expensive. So at some point in time, those two interest rates need to converge. Either the European rates need to become less negative, or the US rates need to go lower. Mario Draghi, the ECB head, today announced that they're going to lower rates even more, and they're going to continue their quantitative easing program. It's only going to work to widen this divergence, so the US rates most likely have to come down in order to close some of that gap. The last reason is inflation. The Federal Reserve have communicated very clearly that they want their inflation data to be closer to 2%. The inflation data they use is something called the PCE, which is the personal consumption expenditure, and they use the core data for that. Their target is 2%, and you can see on page 12, we've only achieved that once in the last 9 years, and that was back in 2012. Today, we're closer to 1.6%, so we're below the inflationary levels that the Fed would like us to be. And now they're even talking about compensating for being too low for too long, to where they could run hot for a while and have inflation closer to 2.5 or closer to 3%, which means even an easier rate, even if the economy starts to do better, it's still going to argue for lower interest rates from the Federal Reserve. On page 13, I find this one particularly interesting. This is the developed countries in the world's fixed income markets, everything from their policy rate to their 6-month, 1-year, 2-year, 3-year, all the way out to 30-year bonds. In the red, this is all the negative rates that you can enjoy if you live in those countries. If you're in Switzerland, for instance, and you want to put your money to work for 2 years, you only need to pay the Swiss government 117 basis points. If you're in Germany, you pay the German government 90 basis points. And if you're in France, it's 82 basis points. So In Europe, it's become a game of how little can we lose, not how much can we earn. And so that's the situation that they're confronted with there.
So
They-
does that tell you that investing in fireproof safes might be a good move?
Insurance to.
Put your cash in.
Insurance, basic, yeah, exactly. Fortunately for individuals over there, they still allow bank deposits at 0. But for institutions who need fungible securities that they can use and by regulation have to invest in, for instance, you guys have to invest in government guaranteed type of
Right.
securities or government backing. So regulatory wise, you would be forced to invest in treasuries that perhaps could be negative. You can't just take $130 million and convert it to gold or cash and throw it in the vault and then, use a little bit whenever you want to pay a bill. So it creates a real problem at the investment level, but it even creates a bigger problem at the banking level, because our entire financial system and banking system is based upon positive interest rates, and our banking system is just simply not set up to operate in a world of negative interest rates. So I think the probability that we will eventually go to negative interest rates in this country is still less than 50%. It becomes a greater probability the longer the rest of the world stays negative. And if we do move into a recession, that probability is going to grow, and it's something that we do need to think about now, as opposed to thinking about it when it does happen. If we would have had the luxury of thinking about interest rates in 2005 and 6 possibly going to 25 basis points instead of the 5% they were at that point in time, we could have done some things that could help mitigate that change in the interest rate structure. And that's the kind of things that we think about today for you guys is what should we be doing? How can we help mitigate some of this movement if we are moving in that direction, and what can we do about it if and when we ever get there?
Quick question, I know we're on the investing side, but does this start to even affect us? I mean, you start to see where, maybe not cities and states are doing it, but definitely some countries are offering, 40-year debt, or
Yes.
sovereign companies 100-year debt. Publicly traded companies are out just taking on debt. Apple, they don't
Yes,
need the cash.
absolutely.
But they're issuing debt.
That's part of their
because it's so
strategy.
cheap.
Yes, yes.
And the whole, so does that start to affect, I know we always look at 20-year fixed debt now. We
Right.
don't.
Yes.
Does that start to affect that discussion?
It makes the debt environment very attractive, relative to what it was in 05, 06, where you were borrowing at 6 and 7%. Today, you can borrow it at 2% for the most part, particularly for, 1.5%.
We have a state revolving fund loan that's a 30-year term that is around 150. So, yes, it's certainly it's a very different environment
Yes.
for longer-term debt.
Yes, the debt market has been turned upside down. And I think the attraction on the borrowing side will probably be offset by maybe the impact of revenues, lower sales taxes, lower tax revenues through slower economic growth, some of those things. But the decline in the borrowing costs will certainly help to offset and mitigate some of that economic damage that potentially could be done. Okay, let's talk a little bit about your investment portfolio and what happened during the year. Interest earnings took a nice jump because we had a substantial increase in interest rates up until the end of the year. So going back to June 30, 2018, the earnings were up from a 179 on the end of last fiscal year to a 236 on June 30, 2019, which is an increase of 57 basis points, and that approximates the change of the interest rate market in the short end. The portfolio had a nice increase from 132 million to 169 million due to your bond issuance in 19. During this time period, we segregated the bond fund monies from the portfolio to better align the objectives of that portfolio. In bond proceeds, the purpose of the bond proceed monies are to meet your liability projections for your construction payments. And so we took that portfolio and matched up the investments directly to the expected disbursements, which helps maximize the returns of that portfolio because we don't leave it all into cash. We want to get those investments invested, and since the environment has changed for the interest rate markets, that was a very good move. We've locked that up at a relatively high interest rate.
And these are all projects that will be spent within 3 years. So these were, Franklin Road was the largest, but about 80% of that 19 bond issue were road project monies, but they were all invested less than 3 years.
So if we go to page 16, it's a comparison of the fund balances that existed on June 30th of last year and the fund balances of June 30, 19. And we can see that the core fund was 92 million last year, and it had grown to 114 million this year. The interest rates showed in 2018, interest rates were rising, so you had unrealized losses in securities that you'd already purchased because new securities being issued were at a higher interest rate, so you had unrealized losses of about $424,000. And that completely reverts itself with the decline in interest rates in the first half of this year to where you had unrealized gains of almost $1 million. And today, that figure, I think we looked at it today, was by 1.2 million, or a little over $1 million in terms of unrealized gains. Your yield at cost in 18 was a 170 versus a 241, so we were able to improve the yield on the portfolio. And most importantly, you extended the portfolio out, so you've got the portfolio from an average maturity or average duration of just under a year out to 1.2 years, which helped to lock in those higher rates. The liquidity portfolio went from 39 million to 24 million. We didn't need quite as much liquidity. And also then we have the bond proceeds portfolio, which didn't exist in 2018, and now is a bond proceed portfolio of about 30 million, and it's invested at a yield of just under 2% with about a 1.6-year duration. On page 17, we can see that you've got, the city's had an excellent growth in terms of their funds invested. You had about 85 million on average invested in 2017. That grew to 122 million in 18, and then on June 30th of 19, it was 137 million dollars. But most importantly, look at the growth in the interest earnings from 750,000 to 1.6 million, and then almost a double to $3 million. And you can see the corresponding book yields underneath that, where you've grown from 88 basis points in 17 to 137 basis points in 18 to 222 basis points in 19. The total return line down below shows the amount of money that you would, or the earnings that you would have achieved if you sold everything on June 30th of each year. And that was 39 basis points in 17, 113 basis points in 18. Both of those are lower than the book yield because you had unrealized losses in the portfolio. But that reversed itself in 19, where you have almost $1 million in gains. And so you're earning 222, but if you would have sold everything on June 30th, you would have realized a return of 3%.
And I would like to make the comment for the committee that certainly while we do have to, in preparing, for instance, our financial statements, we do have to recognize mark-to-market for June 30th on our investments. We do purchase securities that we intend to hold to maturity and not realize losses, from having to sell early. Certainly that there are extreme cases where some governments have to sell investments early, but that is part of why our investments are short, and we target our investments to where we believe our cash needs are at. So we do record mark-to-market, but we do not typically experience those losses or necessarily those gains from selling early, because that's not the intention when we purchase those securities.
On page 18, this is an asset holding breakdown and how you're allocated across your $169 million. And you can see that the biggest percentage is in federal home loan banks and U.S. Treasuries. So almost all of your money is held in very highly secured issues of Treasuries and agency securities. On page 25, you can see the maturity structure of the core portfolio. And this looks a little skewed because we have buckets that are just 3 months in duration here for the first 4 buckets for the first year. This is on page 19. Oh, I'm sorry, page 19. There you go. And then we have a 1-year bucket for 1 year to 2 year, and then a 1-year bucket for 2 years to 3 years. So we're pretty equally invested across the maturity range in the core portfolio. Same
Dave,
thing.
Quick question. So I
Yes.
guess, and maybe this is a city question, do we have specific parameters though, like how much we should have in US Treasuries versus Fannie Mae, Freddie Mac? I mean, again, if we're getting to an interest rate negative environment, you would think that that might need to change as well.
We do have constraints that we put on the portfolio in terms of identified objectives of what we want to invest in and the limitations of those dollar amounts.
Your investment policy, yeah.
28% in 10-year treasuries, if they're negative, we can always adjust that.
Correct, right. Although you'd be, limited by state regulations in terms of their requirements, right?
Yes, we do in our, it's toward the back of the investment policy, page 9, I'm sorry. Thank you. Actually, page 9 of the investment policy has a table that has those parameters.
And I don't know if there would be anything we'd want to look at with the changing environment. I know we refresh it every once in a while. I think we last updated it maybe 2 years ago, something like that.
And we did some tweaks in what we just went through
What you talked
this
about,
time.
yeah,
We actually
right.
did make some tweaks in the table, but yes, we do have parameters.
And the only defense against declining rates or potentially negative rates is really longer durated investments and trying to keep your duration out as long as possible in order to capture the yields that exist today that perhaps won't exist 12 months from now. That is, you want to continue to stay in treasuries because if yields are going to decline closer to zero, it typically is going to imply that we're moving into a worse economy, potentially a recession. Corporate spreads would widen out, other higher credit or lower credit type of spreads would widen out. So the securities that'll perform the best would be treasury securities, the ones with the highest credit. On, let's see, it's the proceeds of the bond proceeds portfolio, which is matched up against your expected liabilities. And then on 21, the plan for next year is really to continue to do more of what we've been doing. That's keep a focus on our cash flows, try to maximize our maturities, maintain liquidity at the required amount, but the minimum amount that is necessary to meet liquidity. Understand that the core portfolio is really an excellent area of contingent liquidity because if you get into a situation where you need a certain amount of money tomorrow that you don't have in your liquidity portfolio, extremely short. You do currently have $1 million in gains in your core portfolio. So we look at the core portfolio as a backstop contingent liquidity portfolio. And remember that 1/3 of all your money is invested in under 12 months in the core portfolio because it's typically weighted about 1/3 in 1 year, 1/3 in 2 years, and 1/3 in the third year. So there's a significant amount of contingent liquidity in the core portfolio, but we want to keep that core portfolio out as long as possible in order to maximize those earnings. And then maturity diversification continues to be extremely important in an interest rate environment that is changing dramatically. We want to make sure that we've got a good diversification of maturities across the board. So in 22, let's look at the cash flow patterns over the last 3 years for the city. On page 24, these are some maturity constraints that we follow. Here, the policy is to make sure that we have 10% of the entire fund under 30 days at all time. Right now, you have 18% under 30 days. 50% under 2 years is your policy requirement. You have 74% under 2 years as of June or July 31. And then under 4 years, you need to have 100%, and you have under 100%. So everything is in compliance in terms of the amount of money that we need to have in those particular buckets, which I think alludes to some of your questions there. On page 25, these are the allocations into the various securities. So we can have up to 100% in agencies and up to 100% in treasuries. And then it's broken down to the other securities that are implied in the investment policy that are legal investments. And that includes municipal debt of the city, certificates of deposit, commercial paper, bankers' acceptances, repos, and then the local government investment pool. And you can see the percentages there, and everything is in compliance with that. For next year, I think we need to plan on lower interest earnings because of the lower interest rate market. So instead of having $3 million in earnings, depending upon the average funds under management or invested for the city, I think that most likely it would be prudent to think that the interest earnings will be a little bit lower next year than what they were this year, particularly if we continue on that path over the next 12 months from now of 100 basis points lower in yield. That would be expected to create a smaller earnings number. But we're going to continue investing the funds in a disciplined manner, making sure that liquidity is met first, and then we try to maximize the returns by keeping that duration as long as possible relative to what is needed for cash flow and liquidity. So at that time, I'd like to open it up for any questions you have. If anybody has any questions on either what's happening in the markets or what's happening with the city's portfolio, please let me know.
I think we kind of asked the questions as we went along, and does any committee member have any questions? Thank you for the report. Appreciate that.
Thank you very much. Thanks.
Very interesting.
Thank you.
Christine, do you have anything else to add to that?
No, sir. We appreciate Dave coming to be with us today.
All right. Are we ready for item 9? Let's go to the fiscal year 2019 fourth quarter financial report. Eric, Christine, and Mike, any of the three.
Take it away, Mike.
Good afternoon. For the fourth quarter report, the city is required to close its books within 60 days. These numbers you have in front of you have already been submitted to Crossland Associates, who will begin their audit on Monday. They'll be here for a period of 3 weeks, and then after they do their audit, they are scheduled to return to do their audit presentation on Thursday, November 21st. When I was trying to come up with the highlights out of this report, I was trying to get down to a top 10, and so what I ended up with is a top 12. So if the committee will permit me, I will go through those 12 items from this report. As Christine mentioned earlier, the general fund appears to be closing with a fund balance of $3.7 million, and that's a surplus. And finishing, the fund balance would be over $53 million. Local sales tax increased 5.9% over last year, and it was actually slightly above the amended budget. Property taxes from the TIF district were sufficient that we were able to prepay $600,000 toward IDB variable debt.
So what does that reduce our time frame on? Does that reduce our time frame on that then?
This is still where we project probably about 2023, but then we
Okay.
will have to maintain the TIF for at least one more year to be able to repay the general fund back. So
All right.
it's getting sooner, but we will be able to recognize that, prepay that several years earlier than what was originally expected.
And of course, that is driven also by additional development that happens in the district. And there are some things in the pipeline, so somewhere in that time frame.
The next item, state share taxes finished strong, up 4.9%, and a big driver there was the hall income tax. It was 2.2 million, and we had $750,000 budgeted. Most funds saw an increase in fund balance, and I'll list them: the sanitation fund, road impact, facilities tax, hotel motel, parkland dedication, CDBG, debt service, capital projects, and the water sewers net position, as they do not have a fund balance. Some funds,
Let me note on sanitation, that is an addition to it with no general fund subsidy in there. In the past, we may have had a little bit of uptick in the fund balance, but we had transferred some general fund dollars in there. And in this year, we were not required to have any, and we're able to contribute, as you see here, nearly $800,000 to the fund balance. So that's a very good sign.
yeah, and that was one of the highlights. And I actually looked back in 2008, that transfer to sanitation was 4.5 million. Some funds that did see a decrease: street aid, it had additional spending budgeted. County facilities tax, there was $1,750,000 transferred to the capital projects fund for the 96 West Trail. The stormwater and the drug fund both had amounts that were spent that exceeded the revenues. So those were the only funds that had a decrease in fund balance. Transit was the one fund that stayed the same, because what happens is they essentially do get a subsidy from the general fund, and we actually only transfer the amount needed, so they stayed even at where they were. And the one thing that Transit did is we kept tracking to see where their grant proceeds were, and we actually had a budget amendment for an additional $1 million on top of the $2 million. And it turned out, once they got those monies in, only $800,000 of the initial $1 million was needed. So that was a good result at the end. For the first time that Eric just mentioned was about the no transfer needed to the sanitation fund. All lease purchases, if you remember, we were buying some items and paying over a few years' time. All of those, as of 2019, are paid in 2019. And in May, we issued new debt of almost $30 million and refunded the Build America bonds. And the last item I had is, in 2019, there were capital costs in several funds. The water sewer fund spent $12.5 million on the wastewater plant project. The facilities tax fund has spent $1.4 million on the fire station in 2019. Fire Station 7, I'm sorry. The 2017 bonds spent over $2 million on the communications equipment and $1.2 million on Tower 1. And the 2019 bonds spent almost $2 million on police vehicles and $1.2 million on Tower 2. So those seem to be the major highlights in 2019. Were there any others, Christine, Michael, or Eric, you wanted to highlight?
Just that those fund balances that ended negative were planned draws against them. Street aid and county facilities and stormwater were all related to capital projects, or we knew that we had a higher fund balance in street aid going into the year, and we tried to get more paving done.
And at the end, all your fund balances are in positive position, which is
Exactly.
where we want to be.
Exactly.
Did we use county facilities for the sewer project that we're showing?
Yeah, for our portion, we're splitting that cost between us and the county schools, and our portion is coming out of county facilities tax. And as Mike mentioned also, we did use a segment of the 96 West Trail project that will connect schools, Freedom Middle and Poplar Grove campus, to the Freedom Intermediate and Johnson Elementary campuses. That segment we're pulling from some county facilities taxes as well, because it helps connect to schools.
Any other?
No.
I've got an item 10 on there. Did you see? They snuck it in on the back.
No, that's it.
Monthly report for September. Mike, you're up again.
Yes. For item 10, I may just want to highlight one particular number. and it's for development fee revenue. Last year, when we were doing comparisons, it was lower than when it was being compared to a record year. As you look at the monthly reports starting here with July, we're noticing some of those are now higher than last year's numbers. So I just thought that was some information that was coming once something wasn't being compared to a record year.
Just have one question to ask overall, and that is, whenever we've got those comparison dates and everything, and I don't mean year to year and
Yeah.
everything, when do we ever change the comparison dates? Because at one time it was like 10 years, but now it's gone out to 12 or 14 or something like that. And, I mean, are we ever going to, change the charts on where the first year is different? I mean, as I say, are we going to have just a certain number of years that we compare to, or are we just going to go from 2007 on forever?
I know 10 is typical, but if there's a different time period of comparison,
Oh, no,
we can
I'm
always.
just saying,
Yeah,
I think
We
we
just keep
probably.
adding years
I
as
think we just
opposed-
keep adding years. We never
Yeah.
changed our
yeah.
comparison date,
And I think Alderman Peterson's
Yeah.
looking at the building permits, and
Yeah.
we've got 11 years.
Yeah.
So we
Oh,
certainly
it's
can.
not just those.
Yeah,
We
yeah,
can-
yeah, let us standardize on 10.
Yeah, just
if
an
that's
idea,
appropriate.
just
Yes.
an idea.
I think the only reason that's ever beneficial right now is because the recession that we went through on those back years just
Yeah.
gives you a sense of its impact on us. That's the only thing I get from it, is that, we know how much that slowed some activities, and we've recovered so strongly since then, but it does give you an interesting point of comparison. But yeah, I think 10 years is probably
Yeah.
logical.
We do try to give you in the revenue model where the data is available. At minimum 5, we try for 10, but then we have averages built in of 5, 10, 20, and in the case of sales tax, 25 years of
Yeah.
projection, depending upon, again.
I don't see the 25-year anywhere, though.
No, I'm saying in the annual
When we
revenue
do
model, in the
revenue.
budget
Yeah,
process,
okay.
not in the monthly reports.
But let us do that for next month.
Just
We'll
a
do
thought,
10
just a
years on
thought.
each of those schedules.
That was my comment on that.
My only question, obviously, when we look at the grants, I mean, half of that is the Columbia Avenue, just checking in on, are we still in design? Is that right? Maybe wrapping up towards end of the year, first of the year, something like that?
Uh,
Working through the design process.
Okay.
I can't give you a date off.
Yeah, sure,
yeah,
sure,
yeah,
sure.
yeah.
And then my standing question is always on the conference center, why we lost 63,000. And do we ever have conversations with the county, and because we own half of it, and are they just happy to, or?
They have, the county staff has has been comfortable with city staff being certainly we take the lead. We also take the lead in the audit preparation. Of course, our Crossland is also doing field work on the conference center. Something that City Administrator Stuckey and I have discussed recently is we're going to invite the leadership from the conference center in Chartwell to come to a committee soon, because we certainly always invite them during the budget process, but we're so busy during the budget process. There's a lot of things going on, so we're inviting them to come to hopefully the October meeting. And similar to the way we invite the investment people in September to, to something like a dialogue like this. So we've extended that invitation.
Yeah, I think that might help us maybe delve a little deeper in their operations where they're moving. You have Chartwell, who's now been in ownership for a little over a year, so they've sort of settled in and see where their plans are. And they've obviously taken a pretty aggressive position as a company in this market. And so we thought that would be an interesting discussion. So as Christine said, we're looking for October to bring them in and talk a little more.
My only comment would be, if I'm looking at the last year, did we gain $300,000 in it? It looked like it.
Yes,
So, yes.
So,
La-
I
last
mean,
fiscal
that's a
year.
reason, a positive reason to
Yeah.
continue with that relationship there.
Well, again, I mean, if it's a $20 million asset, and then it's a 1.5% return, I don't know. I mean, I would like to know where they're headed, and, since we own it, we don't pay property taxes to ourselves, and again, if they have a great vision for it, that's great. I just would like to 300 is, I know it's a big number, but is it a percentage of what?
And certainly, we think it's likely we'll be working with Chartwell for the extent of this agreement. There's an agreement for another
There's an
eight
operating agreement, yeah.
years, in which Chartwell, their 1 year is I believe November 1st. So this is, I think, a good time to have that conversation with them. But my as a staff working with their leadership, especially with Chartwell, is they do intend, I believe, to be in this market for the long haul. They are looking at this facility, and even to this year's capital program even has more landscaping, cleanup. They're really, I believe, looking at the facility both as new owners of the Marriott, of the hotel, as well as the conference center, in probably a more long-term fashion than we've seen, and with the previous owner. But they are also management that's right across the street, and they're no longer being managed by a company that's out of state. So that's a closer set of eyes as well.
Mayor?
If I could make a comment about the conference center, please. You know, certainly, that's not a great return on our investment, the conference center. But you got to also think about the 1.73 million tourists that visited last year and the amount of money that they leave every day. And they wouldn't be doing quite as much of that if that conference center wasn't there. I was out there yesterday for about 400 public health workers and speaking to them. They come back every single year, and they're excited to come and spend money in our mall and downtown. So those are kind of not tangibles based on that investment. And we have had a number of conversations with the county at a high level over the past year, and a lot of discussions. You know, one of the challenges is that there's so much interconnectivity of all the functions of the building that, you know, you can't cut it in half. So, you know, to me, one of the great opportunities we have since we own that property is, you know, it could be a vision for a larger conference center, could be a vision for a park and ride in that area. So who knows? It's a nice asset to have at this point.